What's up, everybody? This is YouTube Live, everything Phoenix style, and you know what time it is. It is Monday, and it is time for a market update. And in this one, it's going to be a little bit more of a broader update from the economic side, because I'm sure you've heard the news starting last Friday as to what is going on with the entire economic future forecasting with a potential recession on the horizon, according to some of the prognosticators. Now, I don't know if that's going to happen. Who knows? We'll see. It is an election year, and that's coming up here in just a few months. And you have this high inflation that just doesn't feel like it's really coming down much, even though the reports are saying that it's kind of under control. At the same time, you go buy your groceries, you go buy certain things at certain stores, and the prices just don't feel like they've come down a whole lot, even though the PCE report is showing that it is not quite to the Fed's target rate of 2% yet, but it is just slightly above and hopefully being under control. But we're going to cover a couple things today regarding the inflation, because I think it's I think I got a special treat in for you when it comes to a presentation I heard, and we're going to share part of that with you today. So stay tuned to that. And then, of course, we're going to go over some interesting things that has to do with the housing market, some articles, and the rate thing is so interesting. Could there be opportunity now in the market when some of you guys thought there wasn't, with where the rates are going? Guys, did you know that the rates hit a 52-week all-time low as of last Friday here in August, right? So this is a good time to consider or start considering further maybe buying that property. We're going to dive in and get started, guys. But if you could, let us know where you're calling from, where you're watching from, I should say, and let's communicate. Like, let me know what's going on. If you find value in this, I'd love to know where you're watching from. Any questions you have, let's make this a two-way conversation as much as possible. But we're going to rock and roll, and I'm going to dive right in like I always do, guys. Let's start with the Cromford report. Okay, we're going to be general, then we're going to go specific. But the Cromford report here says that we are still in a balanced market. Now, last week, this was at 100. Now we're at 99. So not a lot of movement, but it did continue the trend of this downward spiral, if you will, slow, very, very slow spiral. So spiral is probably a little too dramatic here, but it is going in the wrong direction if you are a seller. Now, if you're a buyer, this is potentially good news. But when do you jump in if you're a buyer? That's the question. And I think that has to do with your specific situation. And we'll talk about that here in a second. But you see the supply is pretty high. That's why it's in the green. The demand is pretty low. That's why it's in the red. And so you have this whole CMI, this index of 99.7 right now, and a balanced market is between 90 and between 110. So we're almost specifically in a balanced market for Maricopa County. Now, let's jump over here to some different areas. You can see the suburbs of Phoenix. We won't spend too much time on this because you guys get the point. A lot of red on the board, but there is more green than there was last week. That's interesting. Could that be because the summer is, quote unquote, kind of over? And I say kind of over because a lot of the school districts have started up as of today, Monday, August 5th. Now, you already have some school districts in the East Valley and other places across the Metro Phoenix area that do more of the year-round schedule. They started back in July. But you have several big districts that just started here today, and you will have the majority of them starting by next Monday. So now people are back from vacations. They're taking their consistent rhythm more serious, and they're going to make more serious decisions because of that. And so what could we have here? Potentially a little more demand. Potentially, we need that. We need more demand. That's what we're lacking right now the most. So going back over here to the Cromford report, you can see stabilization is not there right now because you have a lot of suburbs going down with their supply and demand index, which is the CMI. And you see the change. Now, what's interesting is you have the affidavits of value are out. These are always intriguing just to look at just quickly, because what's the net? Well, you can see right here. Overall, we see an annual rise in the median sales price of only 0.5%, but it did go up, not down. So well below the rate of inflation. Guys, we know inflation is, by every report, at least above 2%. Right now, we're talking about 3% or so. And then that's on the report. If you believe the report, that's where it stands. If you don't, because things feel more expensive than they have been many, many times over and don't seem to be getting cheaper, you're well above 3%. So prices did increase a little bit. This means the median home price is cheaper than a year ago when adjusted for inflation. That's interesting. The median new home is down more than 5% from a year ago, so cheaper than last year, even before adjusting for inflation. Given that the median household income has risen substantially over the last year, affordability in Maricopa County has improved, though there is no sign yet of this leading to strengthening demand. It would make sense to assume that potential buyers are waiting for mortgage rates to come down. Shocker right there, right? Recent pronouncements by the Federal Reserve suggest a change is in the cards in the short term. That's the net. So let's look at some active listings. Where are they at? Where are those active listings? Well, you can see right here that the active listing map is kind of all over the place in terms of the Phoenix Metro. Now, you can see the interstates, the metros all around here, but where is that green? That green's in the center where you have the older, more established communities. Then up here in the Northeast Valley, a little more red, the dark red, which is more higher price points of active listings, but there are a lot of dots. That's the point. Look at the heat map too. I want to show you this real quick, guys. Contract ratio. The warm and cold areas, you can see where they lie. That means homes are not selling as fast in these zip codes. Okay. I mean, look at 85253, which is Paradise Valley. A contract ratio of 28, guys. 100 is the highest, 28 is low. Now, PV has a lot of luxury homes, and luxury home buyers a lot of times take the summer off. So that should be increasing, but we'll see what happens. You look in Scottsdale, a little bit better. Here's 85255, which is a big zip code. It's at 44, and you have 85259 at 70. That's pretty good. 85260, 24. Whew, a little cold, a little freezing there, right? Not temperature-wise, but contract ratio-wise. Just to be clear, it's pretty hot here in Phoenix right now because it's the summertime, and that's what happens. And because it's the summertime, a lot of times the housing market takes a break as well for a short period of time. All right, guys, you can see right now there is no really hotter. There is no frenzy. There is no insanity. You do have a couple hots, 85259, and this one at 85254, which is around that Desert Ridge area in North Phoenix. Okay, now let's jump into the big story of the week, and that is interest rates. All right, guys, if you've been living under a rock, you may not have heard about this, but if you have not been living under a rock, you know that rates are starting to come down. Let's look at where the 30-year fixed now has ended up to be. You can see right here, Mortgage News Daily, which is our best source that we like. 30-year fixed rate mortgages. Look at this curtailment, guys. Boom. Right now it's down to 6.34 on the 30-year fixed, guys. Look at this. This is a huge discount. So if you're looking for a cheaper monthly payment, this is the start that you want to see. Now, do you gamble? Do you let it just keep going longer and longer? Maybe so. No one knows where it's going to be, but I can tell you now that the market is pricing in that the Federal Reserve will cut rates at least a 25% amount come September when they meet again. Potentially, some people are saying as high as a half point on that standpoint. So that would be a huge cut, a half point. A lot of people think the Fed is behind now, and due to current economic conditions, they need to have that cut. They should have been a cut in July. But the Fed doesn't like to surprise people. And so they did not want to come out because the market had not had a chance to bake that into everything. That could cause more of a bigger shock to the overall economic picture of the United States. So instead, they did not do anything with the rates in July when they met last week. And instead, people are starting to think that it won't be just a quarter point drop in September. It could potentially be as high as a half point drop in September. We'll see. And what would that do? Well, again, we all know that the federal funds rate does not work inversely and directly proportional to 30-year or 15-year fixed mortgage rates. It works in indirect proportion to that, right? So that being said, we'll see what happens. They see the market's already pricing some of the recession worry and news into the 30-year fixed rate right now. Why? Because you can see it right here starting to go down. So now if you go over here, you can see some news that is happening with what's going on in the marketplace. Rates plummet as the market buys into the big shift. This is the new thing, the big shift. You can see right here that the 10-year treasury yield is starting to come down, and obviously rates work in conjunction with that. And this is interesting here, this graph right here, guys. You can see that earlier this year, you had high inflation data and cautious Fed. And so what happened to the rates? They trended up over here in May to basically right now, you had an open-minded Fed with lower inflation data. So rates trended down. And then a week labor market data came out. Our jobs report came out last Friday, and the sell-off continued or occurred. And now you have rates starting to go down significantly. So what did all that mean? Well, if you look at some of the articles out there, there are plenty of them. Matter of fact, if you do a quick Google search, which I did, jobs report last week up here in Google, you can see that, oh boy, stocks plunge. What's going to happen here with the news release of the jobs report being so low? Markets end the day sharply lower after weak jobs report. So this is a CNN article, which is interesting. 3 reasons to worry about July's weak jobs report and 1 reason not to panic. So they're going to spin this both ways to an extent, right? Because no one knows. That's the reality. No one knows what's going to happen on the horizon. But mortgage rates are out there being lower. And if you are a buyer, this is welcome news. Affordability will get a little bit better. The trick is, will the jobs report or the unemployment rate start to increase at too high of a rate? And the Fed is behind this. That's the key. And that's where the soft landing comes into play that they talk about all the time. So you can see that right now, America's robust post-pandemic job market is teetering on the brink after a lousy July hiring report in which the unemployment rate shot up to 4.3%, a 3-year high. The Federal Reserve now has egg on its face after it kept interest rates near a quarter-century high earlier this week. And for the everyday U.S. consumer, economic pain could be coming down the pike as hiring slows. So what does that all mean, guys? That's pretty much all you need to know about what's happening. And then you look at companies like Intel, guys. Intel, this is a Phoenix Business Journal report just came out. Intel's workforce to get a 15% cut as chipmaker offers a sour 2Q report. There's a picture of Intel's corporate headquarters, which are located in Chandler, Arizona, and they are cutting back 15% of their workforce. This is not welcome news to everything that's happening right now in the economy. So is this the start of something larger? Maybe, maybe not. Now, here's the thing, guys. You don't want to overreact, okay? So hopefully you're coming to this live show saying, Kelly, what's going on here? And I'm not overreacting because who knows what can happen. But I always like to think for myself to an extent, right? Knowing the data that we have at hand. Now, what typically happens is that in August and September, you do have a pullback on the overall U.S. stock market. That's typically the traditional forecast of what happens overall with the stock market. And then there's some buying opportunities potentially there. And then you usually have a fall or a Q4 that usually turns into be fairly decent. Now, I'm not a stock market financial advisor guru by any stretch of the imagination. I'm just giving you some historical trends. Could happen, could not. I don't know. But what I do know is that when you do have inflation that doesn't seem to get quite lower to where it needs to be, you have job reports that are being altered after the fact when they come out, which they happen over the last several months, to which the job claims are actually higher than what they had initially come out to be when they reported them. And then you take the most recent one and you say that the unemployment rate is at a 3-year all-time high, because job reports were not that good and jobs created were not that good. You start to look at it and go, okay, this rate cut is coming and it's probably needed. Now, they're not meeting in August, so it's interesting because you could probably need it in August. But what will happen this month is going to be a momentum for the rest of this year. So we'll see what happens, guys. But I think that rate cut is needed. That is welcome relief for a home buyer. So the question becomes, do you wait until September to see what happens, or do you jump into the market right now with a lower 30-year fix than what we've seen in an entire 52-week time period and get the house that you want while you still have good negotiating power? I think that's the key. You can still negotiate rate buy downs. You can still negotiate terms that are favorable to you without having, hopefully, other buyers jumping into the fold, because people will get off the fence when rates come down. That's just how it works. All right. Now, going back over here, I want to show you guys this presentation, as I thought it was pretty good. So here we go, guys. Federal funds rate and money supply. I love that little gift there, if you will, with this guy trying to mop the ocean. But why is money supply always increasing? Historically, growing money supply signaled a growing economy and or a looser monetary policy. This typically meant central banks were allowing more money into the economy to promote growth. So what is that? Why is that important? Well, I'll tell you why it's important. Okay. Lowering interest rates, which spurs investment, and through putting more money in the hands of consumers, making them feel wealthier and thus stimulating spending. Okay. That's the benefits. What are the disadvantages of increasing that money supply? All right. Adding more money to the economy can also run the risk of causing out of control inflation due to the premises of supply and demand. If more money is available in circulation, the value of each unit of money will decrease given an unchanged level of demand, making things priced in that money nominally more expensive. That's inflation. Look down here at the graph, guys. This is from the Fred report. Okay. The money supply increased dramatically right here in 2020 because of COVID. And then it continued to be increased after the fact for spending on, helping out countries across the world with their war efforts and our own border security and the issues we have here at home and all kinds of stuff, right? But it increased dramatically from the money supply that was being increased over here. Now, here it was being increased, but it was being increased at a gradual rate from 2010, 2009, or whatever on. And then it really spiked here during COVID, and then it kept continuing to spike. Well, the federal funds rate spiked with it. Why? Because it caused inflation. And that's what needs to get under control. So what needs to happen is a lot of this money needs to continue to circulate through our economy without more being printed or more being spent. And then hopefully inflation can come down. But guys, there's really no magic bullet to solve this quickly. And that's why you've seen rates be at the all-time high for so long. So hopefully that makes sense, guys. Hopefully that makes sense. And with this report being out there that I'm showing you guys, it's pretty intriguing. I'm going to go back to it here in a second and show you a couple more slides because it is very intriguing. But the definition of inflation is too much money following too little goods. And when you have that, you have inflation, and that's what's the Fed's trying to get under control. And it's taking some time because that's how it works. You can't just flip a switch and have it be gone the next day. All right. So now we're going to go back to share my screen, and we're going to go back to this presentation, and we're going to move to the next slide. This is the Fed economic data report. Again, we talked about the Fed funds rate, 10-year treasury, and 2-year bonds. You can see that it's been a waiting game right here, okay, for about 14 months. And then you can see how that's circulated with recessions back up. I mean, it's very evident where we're at and what's happening. So a recession, it should not be a surprise to anybody at this point, given the cyclical nature of the historical economic data, that should be coming anytime soon because it most likely should be based upon this data. Okay. You can see all these arrows right here, guys, of recession, then following the economy here, guys. So as you look at the private sector earnings here versus 3.2% growth rate, and you can see the annual appreciation of wages and income, and the nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Now, unemployment rate, you can see right there with the 2-year bond yield, and there's so much economic data that you can go through that will tell you that we are poised, there you go, to have some sort of economic pullback here coming soon. Maybe not, but most likely given the data, it's happening next, given those arrows right here. So no one should be surprised. That's the point here, okay? And then right here, you saw this from August 1st. The Dow sell-off intensifies, drops 500 points on economic worries. Live updates, guys. So the initial jobless claims went up, and the unemployment rate, is at its all-time 3-year high. So that is the deal with that. Hopefully that makes a lot of sense as to why things are happening the way they are. All right. Now we got that out of the way, and you got your data for the week. We're going to jump into some better news. Well, we're going to still hit in the economic news to an extent, but let's jump into the housing market with the Phoenix Business Journal and what they have to say. Okay, here we go. Number 1, Valley luxury homes see price drops amid summer doldrums. Guys, we just talked about this, that the luxury properties throughout the Valley are not selling as fast as they once did because the summertime usually brings a slowdown, a pullback on demand from luxury home buyers. But could that pick up this fall? It's possible, even with a economic recession to an extent, right? Why? Because luxury home buyers sometimes don't care about what's happening with the interest rates, okay? So that will be interesting to see what happens. The National Observer, why home buyers should check their expectations, okay? Industry experts believe rates will never go back to historic lows seen during the COVID-19 pandemic when some buyers snag rates below 3%. So that is a very good thing to keep in mind, guys, that yes, rates should come down, but if you get something with a 5 in front of it, holy cow, you got to think about maybe pulling the trigger. But what is the amount? What is the amount, guys, that people will in mass get off the couch and start actually looking to buy a house and trade in their 3% mortgage for a mortgage that's higher? Is it 5.5, 6? It's somewhere in that ballpark. And I think that number for Phoenix is somewhere around 5.5 to 5.75. Okay. Did you know that Arizona is the third highest ranked state in America when it comes to the gap between the average interest rate on a 30-year fix that the average homeowner has in Arizona compared to where rates currently stand today? So that just simply means that the gap's larger for someone to say, well, I got to get out of my mortgage and then go into a higher mortgage. Whereas other states, the average homeowner might be a little bit higher, so the gap's not as big, and therefore they're willing to trade up their mortgage maybe a little sooner. So we'll see how that plays out for Arizona. The good news for Arizona is that we have such robust economic activity and companies coming here and moving here on a weekly basis that the amount of jobs being created here are creating the influx of population to continue to come to Arizona, which will continue to spur our housing market. Okay, now I'm going to share my screen and get back to the show. All right, let's go over here. Why is the stock market down? Here's what businesses need to know. Now, we are not going to go through this whole article because we just covered the majority of that, but we know why the stock market's down. It's because we have the unemployment rate rising and the inflation still not being fully tapered like the Fed has hoped to do. I've said for a long time, guys, the soft landing that the Federal Reserve talks about having every time. I mean, how many times have they actually converted that? It's so little, it's not even funny, right? Very, very few times have they actually achieved the soft landing. And usually they're playing catch up and they don't quite time it right and they're behind the 8 ball. Well, I think this is going to be the case in this scenario as well. Once again, unfortunately, I wish it was a soft landing, but unfortunately, I don't think that's going to play out that way in Q3 and Q4 of 2024. All right. We talked about Intel cutting their workforce. That's not good for the labor force here in the Phoenix area as they are such a large employer. But then you have this article, why housing prices are still on the rise. Now, we just covered that the median price point actually went up, even with the affordability issues up until this past week. Now, that could change as the trend is going down. Again, that's the median price point. It's up a 0.5 percentage point, but that is trending downward. And I would expect to see, in the next month or so, that median price point when the numbers come out month over month to actually be trending down and be in the negative to an extent. We need demand to pick up and to bring that number a little bit higher. Okay. So again, the reason this article too also shows this is because the Case-Shiller index data is always about 2 to 3 months behind, and it's going to show that Phoenix obviously had a plus on the price appreciation side. Okay, I love this article because let's talk about Arizona as a whole. Arizona Credit gets boosts in ratings from Standard & Poor's on strong economic growth, guys. If you have a strong economy locally, your housing market will always be a little more insulated, right? No matter what the national picture or scene is doing, your local economic housing market will be doing better if your economic picture is much better than other cities across America. And here you go. Hot on the heels of Maricopa County being named number 1 for economic growth nationwide, the state's development prospects have received another boost from the S&P Global Ratings Agency. Okay. Its outlook on Arizona's overall credit to positive from stable and affirmed its AA issuer credit rating for the state, while it's also affirming its AA long-term rating on Arizona's general fund appropriation secured certificates of participation. That's a lot. It's a mouthful. But the good news is that the positive outlook reflects our view of strengthening reserves and ongoing revenue and expenditure management. This is really good stuff, guys. And then on top of it, we have, like everything we talked about, on top of it, we have a state income tax that is flat. That's right, guys. Did you know that Arizona's state income tax is a flat 2.5%? No matter if you make a lot, a little, you're paying a flat 2.5%. And it's the lowest state income tax in America for any state that does charge an income tax. Obviously, there's some states that are zero, can't beat that. But when you do talk about an income tax being charged, Arizona is numero uno for being the lowest, which spurs economic growth, which is a very good thing that any state would probably want. Okay. So hopefully this made a lot of sense. I do love the fact that when you talk about Arizona's future and its outlook and it's bright, it really is, guys. And it's hard to deny that. Now, does that mean Arizona cannot have a Are they recession proof? No, absolutely not. It could still have a recession, but I think Arizona will be the cleanest shirt in a dirty closet when that happens for most states out there in America. Now, let's also talk about Arizona's economy. Okay. Arizona's economy is extremely robust right now. And I think when you talk about the economic activity, the amount of jobs coming here, over 250 on application right now to apply to potentially have and explore the possibility of moving their company down to Arizona. I think the outlook is so bright that when this happens, this recession that may or may not happen, but when it does happen, we will be insulated and your dollars will be more insulated and your housing equity will be more insulated as well. But give us a call. We love to chat with you about any of this, guys, because every situation is different. And so maybe renting for a period of time is the right play for your situation, but maybe it's not. Either way, let's have a conversation with you and maybe talk to you and guide you through the process of what it takes to buy a house in the state of Arizona or even sell a house in the state of Arizona. If no one's taking the time to walk you through that process, we'd be happy to do that. You can call us at 480-660-5974. Otherwise, guys, until next Monday, we'll see how this week plays out with the economy. It's interesting. Things are changing a little bit. I think the tide is changing with rates. We'll talk to you then, guys. So keep it classy, Phoenix, and we'll talk to you next Monday.